Our data has shown that 10% of the companies yield about 80% of the returns. And because of that, if you become way too big, what ends up happening is the size of your fund determines how much you invest in the company and not how much the company needs. It also causes you to kind of push up your prices because you got so much money to deploy, but you can only do so many investments. And then the likelihood of you getting that elephant return goes down. The best funds, the most important factor is, VCs are kind of guessing what the customer wants and waste a lot of entrepreneur time sending them on wild goose chases, talking to guys who will never buy from them in a million years. So what we've done is we've actually reversed it. We've said to the big corporates, what are you looking for? Do you really have an intention of buying? Do you have a budget? And do you have a history of working with startups? So today, 1 out of every 8 introductions we make turns into a deal. At the end of the day, the great venture funds are the ones who are magnets for great entrepreneurs.
So do you remember, what was the pricing like then in 2002, 2003?
Oh, we were buying stuff for 70, 80% discounts.
So how did you raise the fund?
The lesson that I learned when you're starting a fund from zero, you should basically...
Welcome to The Peel, where we explore the world's greatest startup stories. I'm your host, Turner Novak, founder of Banana Capital, a venture capital firm that's a magnet for great entrepreneurs. I'm excited for this conversation with Alan Feld, founder and managing partner of Vintage Investment Partners. Vintage is one of the largest fund of funds in the world, managing over $4 billion across what is mostly investments into other venture funds, plus some secondary and direct startup investments at the growth stage. Our conversation gets into what exactly a fund of funds is, Vintage's unique take on the model, what most people get wrong about fund of funds, and the value they bring to the startup and venture funding ecosystem. We also talk early days of Vintage and lessons learned investing through 6 downturns. Alan draws comparisons between 2022 and the dot-com bubble and crash, the importance of differentiation in venture and how to do it, advice for raising your first fund and scaling your firm, what Vintage looks for in new fund investments, and why VCs adding value can often waste a founder's time. This is a broad conversation covering the early days of starting the firm up through Alan's plans as he now starts to scale back his involvement 21 years later. A quick shout out to Abe Finkelstein and Ryan Clamage at Vintage, plus Ed Sim at Bold Start Ventures for help suggesting some great topics for Alan. Let's jump in after a quick word from Attio. There's a world where your CRM is powerful, easily configured, and deeply intuitive. Attio makes it a reality. Attio is a CRM built specifically for today's modern company. It's flexible, easily configures to your unique data structures, and works for any go-to-market motion, from self-serve to sales-led. It automatically enriches your contacts, syncs your email and calendar, lets you create powerful reports, and quickly build Zapier-style automations. The next era of companies deserves more than a one-size-fits-all CRM with outdated UX. Someone recently described Attio to me as the linear of CRMs, which if you're in the know, that is high praise. Join 11 Labs, Replicate, Modal, and more. Try Attio instantly at attio.com, that's attio.com, or tap the link in the show notes and scale your company to the next level. Alan, how's it going? Welcome to the show.
Thank you. It's an honor to be here. I appreciate your inviting me, Turner.
It's an honor for you to be here. I guess I first off wanted to say thanks for being investors in Banana. Really appreciate it.
Our pleasure.
So the first kind of question I thought we could kick this off, we're going to kind of touch a lot of different things. Can you really quick just explain what Vintage is?
Sure. So I started the firm 21 years ago. We manage today roughly $4 billion. About $2.3 billion roughly is fund to fund. So we invest in other funds, 85% of which is the US and Western Europe. Only venture. We don't do anything other than venture. Mostly early stage. We have another $1 billion roughly in secondary funds where we buy positions in funds and in companies. And then we also have roughly another $600 million in direct investments. We have growth funds, but it's mostly co-investment with the managers that we're investors in. We don't believe it's the right thing to do is, to compete against the funds, which we're, LPs. And so we do our best to, cooperate with them and to, co-invest with them. In addition to that, we have a free service that we created called Value Plus, where large companies tell us what their technology pain points are. And then we identify startups in our indirect portfolio, which today is about 6,000 companies that we think can solve the problem for. So let's assume you're a big corporate and you're a CMO or a CIO or a CFO, and you've got a certain technology issue and you'd love to be a customer of a startup that you're not aware of that can solve that problem. We basically play that role. We've generated so far about 300 purchase orders, over 200 million revenue for the startups, and we haven't taken a dime from anybody. It's a way, frankly, we make our money more valuable to both the companies and to the funds.
So it's kind of that value add thing every VC talks about, but you actually added and track what you've contributed.
Oh yeah, well yeah, and I'll tell you, why we're in a unique position, because we're kind of like a Switzerland of the industry, right? So when you're sitting on top of everybody's portfolio, you can. It's not like you've got a 20 or 30 companies you're promoting. You've got 6,000, right? And so the chances are there's something in there that a corporate wouldn't want. One of the problems that I've seen with value add, and I feel bad for the entrepreneurs actually around this, is people kind of, VCs are kind of guessing what the customer wants and waste a lot of time of entrepreneur time sending them on wild goose chases to, talking to guys who will never buy from them in a million years, and they spend a lot of time. And a lot of time is wasted by entrepreneurs. So what we've done is we've actually reversed it. We've said to the big corporates, what are you looking for? Do you really have an intention of buying? Right? Do you have a budget? Okay. And then, and do you have a history of working with startups? Right. So and so today, 1 out of every 8 introductions we make turns into a deal because, we're pre-qualifying the customer, not only pre-qualifying the supplier, right? Like the startup. And so we don't waste, the time of the entrepreneurs. And that's why a lot of the VCs, which we've invested in and companies which we've invested in appreciate it, because, we're not, trying to waste their time.
Yeah, that's definitely a big complaint I've heard from founders who don't like the whole value add thing, is that it's just it's the VCs forcing the value on the startups that don't necessarily need it yet. So that's a really interesting approach. Maybe a way to get around that.
Yeah. And so, yeah, it's more pull and not push. And once it's pull, there's real demand for it. And so we don't waste their time. We made a bunch of mistakes at the beginning when we started offering it because we did it push, and we realized, wait a minute, this is not founder friendly because we're actually hurting them and we're wasting their time. Let's make sure we know what the guy wants before we actually, create the meeting, so that at least there's a chance to get a real deal. And then we track it, and it's worked. 300 purchase orders is not a bad number.
Yeah, I mean that's what startups should be doing. They should be doing customer research and development and finding exactly what their customers want.
Well, and VCs should be doing it. You shouldn't be wasting the time of your entrepreneurs. So, when we're trying to do that for them.
So, and then I think just so everyone's on the same page here, there's a lot of founders that listen to this. Can you explain what a fund of funds is? It sounds like that's about 60% of your, capital or strategy. If I've never heard that word before, can you just help me understand what that means?
Sure. So one of the things that's interesting about the venture industry, the really good funds continue to be really good funds over time, right? Why? If I'm in the public markets, you don't see a big gap between the best public market investors and the average. Okay. In venture, the gap between the great venture funds and the average venture fund is huge. And why is that? Well, in the public markets, if I think you're a great entrepreneur, Turner, right, I can invest in you. There's nothing that stops me, right? In the private market, you pick who your investors are, right? You're picking, you as an entrepreneur are saying, I want this fund as my investor, right? So there's a selection issue. But the selection is dual, right? It's not just the fund picking the entrepreneur, it's the entrepreneur saying, I want this fund.
I was going to say, it's one of the only asset classes where the asset chooses the investor, right?
Oh, absolutely. Absolutely. And also, look, the other thing that, in the public markets, nobody has unique information. And if you invest on unique information,
it's
you
illegal.
go to jail.
Yes.
You go to jail, right? So you're wearing, as a friend of mine says, I don't look good in stripes, right? And, here you've got, the really good venture funds know a space exceptionally well. and have unique information about, what, corporate company customers want, or what a potential buyer may want, et cetera. And so because of that, if you're a really good fund, you continue to be a really good fund over time. The other side of it is venture's not scalable. There's a point at which you get too big and you're just never going to be able to generate the multiples.
So can you explain that really quick if I've never thought about that before?
Sure. So size is the enemy of returns in venture. There's only so many really gigantic outcomes. And if you scale your fund to a really gigantic number, unless you have multiple ones of those, and it's rare that you're going to have multiple gigantic outcomes to the same fund, you're never going to get a multiple, right? Because you're going to own only X percentage of the company that's probably going to get diluted over time because there's going to be other investors over it, right? So, our data has shown that 10% of the companies yield about 80% of the returns in the venture fund. Now, and because of that, right, if it's really a game of elephant hunting, right, if you become way too big, what ends up happening is the size of your fund determines how much you invest in the company and not how much the company needs. It also basically causes you to kind of push up your prices because you got so much money to deploy, but you can only do so many investments. And then the likelihood of you getting that elephant return goes down. So, the best funds tend to be, like, the most important factor is dollars per partner. So, the more partners you got running after, and the bar is really high on investment, and you want to be the one that has that elephant, you want, that threshold to be of quality to be super high. The more money you have, fewer partners you have with a lot more money, the bar starts lowering.
Is there a good ratio? Like every 100 million, you need one partner, or every 500 million, you need one? Like, what's the number?
It's a function really what the strategy is, because when you're an earlier stage investor and a seed investor, you don't need the same amount of dollars per partner. When you're a growth investor, you're writing, much larger checks for the growth. And of course, the hit rate is higher. The multiples aren't the same, but the hit rate is higher. So anyway, bottom line is, so why do people come to us? Because they're saying two issues. One is, if the funds themselves are capped in size, right, and they're really good funds, they're also picking their investors, right? Just like with the entrepreneurs, right? I can't take unlimited capital, otherwise I'm going to hurt my returns. I can only take X amount of capital. Well, I want to take that capital from investors who are going to help me, right? And so, by positioning ourselves almost as, we call it, the blue collar LP, the LP who works for the GP, we're trying to make our money more valuable and therefore, get into better quality funds than maybe, the average investor's been able to access. That's one. Second, look, this is all we do. We've made loads of mistakes, but we've also hopefully gotten a few things right. And from that experience over the years, when a new manager comes to us, or a breakaway manager or something, allows us to hopefully assess them better. And our network, allows us to hopefully better assess whether this is going to be the next Andreessen or the next Sequoia or whatever, right? And that's our job. So, and what it does is gives our investors a diversified exposure, hopefully to the better managers, which they can access or can select.
And then sometimes too, does it help with like size of portfolio and check size issues, where like if you want to invest $100 million into early stage venture, it might be hard to get that in a certain number of funds, or you could just give it all to vintage and you'll.
Yeah, exactly. And then it goes the other way too, which is, if you're a smaller investor with $5 million and nobody doesn't really wants like small checks in their fund, yeah, we can give you the diversification. So yeah, it works for both cases. And that's why the vast majority of our investors are institutions that, say, look, take this money, put it to work well for us. And we also, by the way, help our LPs build relationships directly with the funds over time. So as the funds decide to scale or maybe, add additional product, we'll have them do that directly. We're trying to be helpful to them in building their own programs.
What do you think is something that people maybe don't understand about the fund to fund model? Just when you think about that as like an asset, like something that people might not realize at first?
I don't think people realize two things. One is how sticky being a good investor is. In other words, as I say, the top quartile tends to it's not a random kind of thing. If you're top quartile, the likelihood of you being top quartile again is a lot higher than if you're a median fund and you're going to get the top quartile. So, and because of that, access is an issue. People sort of say, if I, in a bunch of good good quote names that maybe haven't really generated the returns, that somehow they're going to turn out, to be better, and I'm going to, generate great returns just because I'm in venture. It doesn't work that way. The median fund isn't that great, and if you're not in the top quartile or ideally the top decile funds, you shouldn't be in the asset class, right? And so that's one. The second thing I think is, look, you mentioned this, you alluded to this previously, which is, if you're a big institution, you can't put a lot of money to work in each individual fund, right? Well, if you're a big institution, is that a great use of your time looking at $5 and $10 million checks into smaller funds? Or, why don't you just give it to somebody else who can do that for you and more effectively, and then, know it's in hopefully good hands. So that, that's what we've been offering as the value proposition.
I feel like in some cases there's like a discovery component too. Like, you want to have your own program, you love venture, you want to, be a little bit more hands-on choosing small managers, but you don't know where to start. So vintage can probably, you can say, okay, here's hundreds. We've invested in hundreds of funds.
We track 4,000 venture funds today, right? So, and look, we have a team of 60 people. I mean, to do this really well, you need a very, very large team that, can do it. The other thing too is many of us come with, either technology investment, long-term technology investment experience, or even operational experience, right? When we diligence a fund, we talk a lot to entrepreneurs and co-investors. It's much more important to do that than, frankly, we do all the spreadsheets, but that's just the ticket to play. To do it well, you really have to be talking to entrepreneurs, because at the end of the day, venture is all about the entrepreneur. And we want to know, at the end of the day, the great venture funds are the ones who are magnets for great entrepreneurs. And how do you make that decision? Well, how do you decide that unless you talk to the entrepreneur, right? Like especially if it's an early stage fund, you want to say, wow, is this a guy that, I would back? And do they know their space? And are they realistic about how they're building the business, et cetera? And one of the things we do, we're somewhat different than all the other groups that are funds of funds. We divide by sector. So somebody who's got an AI story or somebody who has a fintech story, our AI or our fintech partner does the diligence so they can talk intelligently to, the entrepreneurs or to the fintech entrepreneurs, et cetera.
And this is because it layers over when you think about the fund investing strategy, the secondary strategy, the growth co-investing strategy. You have one individual like AI who does all three of those categories.
Correct.
Kind of sliced on. Okay.
Correct. But for the fund of funds, it's particularly important because you can have an intelligent conversation with the entrepreneur because you know their space, right? And then also, of course, we can be helpful to them too beyond that, because, when we talked about the value plus, right, we have a team that does the value, but, if you have an industry person who's tracking the company, you can give some real guidance to the value team. Wait a minute, let's not, the real, potential customer is this, not this. And wait a minute, we haven't thought, broadly enough about this company. This technology is also very, very relevant for, this sector too. So we can be helpful beyond that.
And you mentioned something before we started recording. You were doing this for 30 years. Looking back at the data, when we were kind of talking about betting on founders, there's this concept of bringing in an outside CEO, replacing the founders. The entrepreneurs are so important. Does that work, replacing them with an outside CEO?
It's very rare that it works. I have to tell you, the lesson that I've learned from, the good investments I made and the bad investments I made, if you don't believe the founder can build this into a significant, business, don't invest. It's so much about the founders. I know, everybody talks market, but at the end of the day, I mean, look, Turner, you've done this also a bunch of time, right? How many people did you invest in that the exact business model they ended up, doing at the end of the day was what they show you the first day?
Like, I'm pretty sure it's zero.
Exactly. And in 30 years, it's been zero, right? Like, so at the end of the day, it's really a founder who's going to go find the right market, right? And they have to be able to pivot. They have to be able to understand their domain. They have to be able to really, know where to go with the business. And if so it's really people. That's why, we're so crazily, and I know it sounds weird for a fund of funds to say this, but we are so crazily focused around checking entrepreneurs and entrepreneur quality, because especially if you're investing in an early stage seed fund, you got to make sure that person is, getting great entrepreneurs and, into their portfolio.
You're basically buying a portfolio of great entrepreneurs. Like that's what you're doing. There's no real businesses there yet if you're investing in seed funds.
That's right. And so if people are thinking in terms of, this guy's a great technologist, I'll invest in him, let him go build the technology, and then I'll go find a CEO on top of him. Well, you really got to find that unique person or that team combination of, rather than forcing somebody on top of them, having, this great team combination or the one person who's got both of those aspects that can really build a significant operation.
Yeah. I mean, that's the cheat code. It's just, you understand the technology, you understand the industry, you understand the business side, you understand marketing, the numbers, you understand your customers. Hard to find. That's why venture is such a hits driven business. So then I guess one big question. So I want to spend a little bit of time going on this, going all the way back. You're from Toronto originally, right? How did you end up running what's like the largest fund to fund in Israel? It's obviously a little bit different. What's the journey to get there?
I moved in 1984. There was a U.S. investment bank called Robertson Stevens, and I opened up their Israel office in 94. I worked on a whole bunch of public offerings and M&A deals and other things, and really liked it here and got involved in the tech space, and then gradually was a VC myself, and then gradually 21 years ago started Vintage.
And then so you started Vintage. This was 2002, right?
Yeah. Yeah. The markets were way down, as markets have crashed. And I learned the way you make money is you do the opposite of what everybody else does. Right. And everybody was down on tech in 2002. And we thought there was a really interesting opportunity to buy up positions in funds and in companies. And that's how we started Vintage. We actually started as a secondary fund, built the relationships with the managers through the secondaries. And then over time, we continue to, do secondaries. We've got $1 billion there as well in secondary funds. We also do direct investing. We have about $600 million there. But, the natural extension was if you're buying secondaries in funds and companies, then you want to do primary investing also, which led to our fund of funds, and then also led to the primary direct investing into companies as well.
So this is actually something that I think our mutual friend Ed Sim brought up. He said even before secondaries, you were serving on a board together while you were at, I think, Vertex Ventures.
That's right. By the way, I love Ed, and we've been investors with him for a while, significant investors, and he's a fantastic guy and a great investor. It started with secondaries, and I had met Ed because we were on the board of a company together, Answers.com, and got to know Ed and build a nice relationship and a lot of respect for him. And
so what did you see at the time with secondaries, like starting Vintage?
With secondaries, the markets were down, right? Like in 2002, NASDAQ had crashed, right? People wanted out of their technology investments. And I even remember there was an article that a professor at Harvard wrote that in the early 2000 period, that technology is becoming it's like the railway industry. It's going to grow 6% a year. And it's going to be it's topped off. And we said that's ridiculous.
Yeah. iPhone wasn't even invented yet. Cloud wasn't invented yet.
So our view was, look, as somebody who believes in entrepreneurs, right? And as somebody who believes, in the ability to innovate, it was, if everybody's selling, this is exactly when we should be buying.
So do you remember, what was the pricing like then in 2002, 2003?
Oh, we were buying stuff for 70, 80% discounts.
Wow.
But you know what? By the way, junk at a discount still junk, right?
Yeah, fair.
Which is why the important thing is, again, understanding the underlying companies, understanding the underlying entrepreneurs. I mean, The fact that somebody, put a ton of money into a company at a ridiculous price, even if you buy it at 8% discount, you can still end up with zero, right? And you got to make sure that you got to make sure, and we we had enough of those too, by the way. You got to make sure that there's really a story there.
So what did you look at the time? Was there certain themes that you thought made sense or certain companies that you ended up making money on for the fund? Like what was kind of the core of that first fund?
Well, I think the lesson that we had, there were certain things that we thought were really interesting, but I think from the mistakes we made, it was, and this is what we changed. When we did due diligence, we did a lot more due diligence on the entrepreneur. We had a theme around healthcare. We had a theme around all sorts of different areas, but the results were, fortunately we did well on those funds, but when we beat up, 3 times a year, we beat up ourselves. We go offsite and beat ourselves up about the stupid investments we made. As managing partner, I always start off with the stupid investments I made. And one of the things that, we were looking at was, what did we get right and what did we get wrong? And in a lot of cases, we just didn't get the entrepreneur right. And we didn't spend enough time understanding that person. So we may have liked the space, but, the company wasn't going to execute. And we were too focused on the space and not focused enough on the entrepreneur.
Well, I don't know if we've talked about this. What makes a good entrepreneur? Like, what do you look for?
So one of the things that, we've done some research around this actually. And so I'll tell you what triggered the research. I started Vintage, right? I'm the entrepreneur behind it, et cetera. And a couple of years ago, my father passed away when I was very young. I was 11 years old and he had a heart attack at home, and my mother and I found him, and it was a horrible situation. He was a physician, and it was obviously a very traumatic thing, right? And I know how that affected me personally, right? And all of a sudden, I'm the eldest of 3 kids, and my mother's a young widow at age 33, right? And had to deal with all sorts of challenges at that point. And I know that had a very big impact on how I developed as a human being, right? And my ability to face a major challenge and address it, right? And I think one of the things that we do that's a mistake when we look at entrepreneurs, we kind of think their lives begin at age 18. So we start asking them, where'd you go to university? Tell me about your work history. But we don't ask about them as people, really. Who are they? Where did they grow up? What were the challenges they faced even as children? Like, did they work as a kid? Did they, were they competitive? Were they, we don't understand who they are as people. And I think one of the things that, I started to do much more effectively in the last number of years is when I look at a company, I try to learn who the person is. What's the entrepreneur? What did they have to deal with? I mean, one entrepreneur, it was amazing, by the way. Like one entrepreneur, she told me that, she had a situation where her mother, when she was 6 years old, her mother had a massive stroke at a very young age, right? And here she is, she had to deal with a lot of issues in taking care of her mother that, made her who she is. Another person told me he ran away from home at age 15 and, he had to basically, become totally independent at a relatively young age. He had to deal with huge adversity. And all of a sudden you start seeing so many entrepreneurs who had personal crises or family crises who got over those. And you see how that affected their both interest in becoming an entrepreneur. And another thing that we found was birth order. 50% of some of the great entrepreneurs we found, many of them were eldest child. Now, I actually thought the youngest child would be the one who would think out of the box. Actually, the eldest always wanted to take responsibility, wanted to, manage, take things forward, lead, which was interesting. So, so I ended up realizing, hey, we got to understand these people better and not start at age 18.
Makes sense. So a real focus on founders, what drives them, their psychology, and if they're going to be able to run the marathon or the ultra marathon of building a business.
What's interesting also, by the way, Turner, we saw a lot of really good entrepreneurs were paid competitive sports, but interestingly, not team sports, individual competitive sport, which was really interesting.
Yeah, you'd think it would be team.
There's this thing it was, tennis or it was squash competitively or, or marathon running, as you just mentioned, or, other things, which is interesting because I think maybe also because the challenges they had as kids, they ended up learning how to be very self-reliant. To a certain extent, that also translated it into their competitive side.
I can see that. Yeah, like you've been like disappointed or let down by the world, and you just figure out how do you overcome like whatever you need to do yourself to just get past it. So you become very individual in a sense.
But at some point, they have to make a transition to learning how to rely on other people, right? How to manage a team, how not to do everything themselves, but to learn how to delegate. And not everybody who's had that crisis learns how to delegate and to rely on other people. And so, what for me it's meant is understand, that ability to pivot, that ability to deal with adversity in a founder in right through their lives, but then also to do the diligence to understand that, they know how to lead people and to delegate and to realize that there are people who are going to know something better than they do.
Is there certain ways that entrepreneurs kind of shoot themselves in the foot or like avoidable mistakes? And maybe we can tie it back. It's, we just kind of got out of this ZERP environment. Maybe there's a lot of lessons we can learn from the dot-com bubble, and maybe there are even things founders can be thinking about over the next couple of years. Like any big things that stick out to you?
Yeah. One is put yourself into perspective. I think there's a tendency, one of the things that I saw, and I saw this in, I've been through now, depends on what you count. I mean, I actually started my career in 87. So I've been through either 5 or 6, downturns. And, you see a lot of the same stuff in the cycle. One of the things that I saw a couple of years ago was everybody's focused, I have to be a unicorn. I have to be a unicorn. I don't think that was at all important, right? I think that's almost an ego play. I think the bigger issue is, how much money do you really need to build the business? How do you, who are the right partners for you to work with to build your business? The fact that you can run around and say, I'm running a unicorn or not is really not relevant. We had the same thing in the 2000 period where, again, people were way too focused on, the ego boost of saying, I raised money at this value. Okay. I think that wasn't the right thing to do. So I think you gotta be honest with yourself about where you are in that journey and realize there's a next day. The other thing that I see with entrepreneurs is, I know it's difficult to say what my midterm and longer term strategy is and longer term vision, and because the world's constantly changing. But I think a lot of people are too focused on, the product today or the solution today and not thinking, where do they want to go? Too concerned about optimizing the short term and not optimizing the long term. And, at the end of the day, the really, truly great companies are the people who integrate into you as opposed to you integrating into them. And I think the end of the day is you got to be thinking about what's the broader story and always keep your mind on and the eye on the ball of what you do to build a much bigger story and look at each one of the products you're offering. It doesn't make a difference what kind of business you're doing as an interim step toward that. There's too many cases where I think people are just focused on the quarter and not thinking on the longer game. And I think the third thing I've seen is, man, you got to find VCs who know how to be, coaches, advisors, and not micromanagers. I've seen too many cases where a VC manages the business. When the VC manages the business, you may as well shut it down, right? And I there's a big difference between, having a VC put up a mirror in front of you and a VC, saying, this is how you're going to run the business. And they're your partners. So at the end of the day, again, we're betting we're betting on the entrepreneur and we want to be supportive of them. Doesn't mean we have to agree with them on everything. We can argue with them, but at the end of the day, it's, the entrepreneur's decision and you've got to, be respectful of that. And I think entrepreneurs have to be able to stand up to their VCs and realize they're the CEO. And at the end of the day, they're responsible for the decision.
So then when you were raising the very first vintage fund in 2002, 2003, Would you say it would be a similar environment to right now, or maybe 2 years after?
Well, remember, the markets had gone down by the public markets. NASDAQ had gone up to about 5,000 points, and overnight had gone down 80%. So, it was, or largely overnight had gone down almost 80%, right? And it was ugly.
So it was almost like 2022, but it never recovered. It just stayed.
Well, and it just kept going down.
It just kept going down. Okay.
Yeah, it just kept going down. And the other thing too, remember, look, the difference today is, if you look at a lot of the companies today and compared to then, a lot of these companies were going public with $25 million in revenue, right? I mean, you could take pretty well anything that had .com in the name public.
That's crazy.
It was a really, today I see a lot more, a lot of the companies that even got whacked with what's going on right now still are real companies. They weren't capitally efficient because people threw money at them and they tried to, quote, buy the business instead of building the business. They were, one friend of mine said they were chief equity officers instead of chief executive officers. But there's still a business there. There still was a story. Then there was a lot of stuff that they weren't really businesses, and internet penetration then was tiny compared to what it was. And I know that for some of your listeners, this sounds like prehistoric times, but this was before the iPhone.
I'm sure there's some listeners that weren't even born back then. We've got some young listeners too.
People were walking around. I mean, if you had a mobile phone, it was about the size of
like a laptop. It was massive. They were like bricks, right?
Yeah. It was, I when I was an investment banker 30 years ago, I even actually raised money for one of the first email companies.
Wow. How did that go?
Oh yeah, it was great. It was great. It was a company called ComTouch. It went public at one point, but as you can imagine, nobody wanted to pay for email after a certain point, right? So, but yeah, it was a very different time.
So how did you raise the fund? How did you approach it? Did you find like an anchor investor? Did you have some individuals that kind of had supported you for a long time? How did that fund come together?
So the lesson that I learned when you're starting a fund from zero, you should basically get a close done. Doesn't have to be huge. Get a few deals done. Show that you can deliver on the model you presented, that you can do interesting investments. And then when the investor then, for the subsequent close come in, they can see, all right, it's not like a total blank check, right? Like they can see what you consider to be a good entrepreneur. There's something to diligence. And that's what we did. Like, we did a few secondary deals. Our investors could see, hey, these are pretty interesting deals, and it was easier to raise. So I keep telling people, just get the first close done. Get some deals done.
So how do you do a first close?
Usually it's friends and family, it's private investors. It's hard to get, unless you're an investor or a VC with a long track record. It's really hard to get an institutional investor into your first close, or you've got, some special relationship with that institution or that corporation. Usually it's family offices who are willing to take a chance on you. And what I would say is get the family offices wrapped up, get the deal, get a few deals done, and then go to the institutions.
Would that be 10% of your target size, 50% of your target size?
You want enough of a close that you can actually do some deals. So it's typically, I would say, 25 to 30% to a third of your target close.
Okay. And then how do you recommend people to run a fundraise process if they're a VC raising one of their maybe first couple funds or still new at this? Can you kind of talk us through, like, if I've never done it before, how would you advise me to approach it?
Well, first of all, you got to decide you really want to do this. I think people don't appreciate, if you look at the number of funds, that it's rare that a venture fund is going to survive less than 15 years. I mean, the vast majority of venture funds last a pretty long time. And, it's your name on the door, right? Like, you're the one raising the money. You're the one who looked at everybody's eyes and said, put money with me. So you got to make sure you want to be doing this long term. I don't think enough people do that and think enough about it. They're excited, hey, about, being a venture capitalist. And then they realize, wait, my God, I'm going to be doing this for a long, long time. Second thing is, if you're picking a partner at the beginning, I don't think people spend enough time with the partners. One of the things I always recommend to people is spend time with the partner and their spouse. Get to know who they are as human beings. Try and understand, this is a Catholic marriage, right? In many ways.
Like, you can't get divorced? Is that what that means?
Well, no, it's not you can't get divorced, but, in many respects, it's a disaster if a 2-person partnership kind of falls away, right? And and then you've got, how does it work, and then what happens to the team going forward, and what happens to the firm, and usually, you've got to be explaining all that all the time for subsequent fundraisers. You're much better off making sure that this is a person you want to spend the rest of your career with, and you really should do the due diligence in advance of that when you're starting it. So I encourage people to really spend real meaningful time together and know that this is a person they want to spend the rest of their career with. Obviously, if it's a sole GP fund, as a friend of mine says, the advantage with a sole GP fund is, the partners get along.
That's fair. Yeah. Hopefully they get along. Hopefully they
get along. Let's get on the person's good. But at the end of the day, you do want to make sure that, this is a person you want to spend your career. So if you have both of those, then the question is, what do you want to be investing in? Like, what's going to be your differentiator, right?
Is that a big deal, being differentiated?
I think so, because there's so many funds out there today. And you want to show that you're going to have sort of a competitive advantage or a special sauce in attracting entrepreneurs, right? I mean, one of the questions we always ask a new fund is, why are the great entrepreneurs going to come to you, right? Why are they going to go to you instead of going to, the other seed funds that are out there?
Yeah. Sequoia, the benchmarks. I mean, they might want A16Z. It's a big checkbook. Like, there's a lot of different things.
Correct. So you've got to have something different, right? You have to either know a space really, really well, or, you can add a lot of value to the entrepreneur around maybe product, or around design, or around something. Like, there's some, clear advantage, or you're fishing in a pond that other people aren't fishing because of the relationships you've got in that area, or with that kind of founder. So you need something differentiated.
So is there, when you're just kind of screening, thinking about a pitch from a manager that's pitching you their fund, are there any differentiators that you don't think are good differentiators or are not that durable, that maybe wouldn't get you excited versus some that do get you excited?
Yeah. I mean, everybody says, I'm going to be hands-on, or I'm going to be, super valuable. Well, everybody tells us that, right? Everybody's pitching us that, I work really hard to get great entrepreneurs. Well, everybody's pitching this.
Yeah.
Right?
Why would you say I don't work hard? Yeah. Like, I just kind of work a couple days a week.
Exactly. So, I think it's really okay. And frankly, think about you as a GP, right? When you're looking at a company, you're also looking for something differentiated, right? You're looking for an entrepreneur who has unique domain expertise, or a unique technology, or, an outstanding background that is going to make them really, become the leader in the space, right? Well, the same criteria that you're using to decide on an entrepreneur, we're using to decide about a VC, right? Like, why is this VC? I mean, we have a relatively concentrated portfolio, right? We want to be in, hopefully, the best funds, right? There's only so many, truly great funds, right? Well, why is, the question we're always constantly asking is, why is this going to be one of the best funds? Why is this fund going to stand out above everybody else? Why is this fund going to get the best entrepreneurs? And you need something other than, I work hard and I'm a great guy and et cetera. So, you need something.
Are those pretty common? Like, is that common in the pitch when someone's raising a fund? Is like, I'm a really hard worker and people like me?
I'm a hard worker. Yeah, I work harder, and I'm going to, be really added value and okay, great. Everybody says they're added value.
Yeah. Who would come up and say, I'm going to destroy the companies on purpose and ruin things?
No, we're going to work harder than everybody else. We're going to, we'll be with the entrepreneur in the trenches. Okay, fine. But first of all, I don't know if the entrepreneur wants you in the trenches. That's a different story. But, but like everybody's sort of saying that, we're going to be involved and we're going to be, all right. That's like table stakes, right? Okay. So what's the differentiator? What's going to make, the next Mark Zuckerberg come to you? Or, you know what I mean? Like,
yeah. That's good. It's actually, I remember when I was raising my very first fund, an LP was like, if the Collison brothers at Stripe were raising their very first round today, do you think that they would take money from you? It was a good question. It made me think of like, oh yeah, that's basically the point of this is you want to find those types of founders and you want them to like you and you want them to work with you.
Yeah. And chances are you're not going to be the only one trying to get those founders to let invest. Right. And so, chances are when there's really, really, really good, great, genuinely great founders, a lot of groups are going to be running after them. And we're in a competitive business, right? So you got to kind of say, why are they going to let me invest or why are they going to cut back this investor so I can get a piece?
So then what do you think is a durable, kind of competitive advantage there as an investment manager, like as a VC? Like, what do you look at and say that's a great answer to that question of what stands out?
So look, people like, there's no question that people like success, right? I mean, if you've got, if you've proven you're a good investor in a certain space, people are going to want you because you're like almost the definitive statement in the sector, right? You see this with certain AI investors. You see, so one of the things is getting to know a space really early and building a theme around it and being perceived as the go-to person for that space. It could also be, certain skills, right? Like it could be, you've spent a good chunk of your time in product roles or growth roles and you've seen a lot of different ups and downs in a lot of different companies. And the value of you being there and conveying that and helping the founder, build their growth strategy or build their product strategy or, something of that can also be a differentiator. People are going to want, especially first-time founders are going to want somebody who's done this before that they can bounce ideas off of. And what am I doing right? What am I doing wrong, et cetera? Not to micromanage, but, to use that experience, to be helpful. So, you've got to kind of sort of say, almost put yourself in the shoes of the entrepreneur and ask yourself the question, why should it come to me? Right? Why am I different?
Like truthfully, and it's defendable in court, like people won't be like, it's kind of bullshit.
Look, I mean, even with, we've been investors for quite some time in Andreessen Horowitz, right? And, even with their reputations and, Mark, being really literally one of the, guys who,
invented the internet
almost from, day one, they still end up saying, wait a minute, what does an entrepreneur need? Let me, build this massive services, business essentially to support them, right? That's going to be our differentiator. And I think, I think it's a really interesting, I think they've done a really good job with it, by the way. But it's just like running any business, right? I'm in a competitive industry. My product is money, okay? And I got to sell that product to the best entrepreneurs
who might not need the money. They might not need the product.
And money, frankly, in an environment where today, where there's a fair bit of money out there, it arguably is even a commodity vis-a-vis the great entrepreneurs, right? Well, what do you do to make your money greener than the next guy's? And there's got to be something. Now, as an LP, I also got to figure out why your money is going to be greener than the next guy's, right? Otherwise, what am I doing? And why is this fund going to be accretive to me over everything else I've got?
Yeah, that's true. How do you think about adding a new manager to the vintage portfolio?
Is it going to be accretive to our returns? At the end of the day, we're being measured by how much we generate to our investors. And, we manage people's pension money, we manage, foundation money, we manage, right? And I take it, and by the way, we put in a bunch of our own money into this, and we take it very seriously that we're managing other people's money. So it has to be really accretive to our returns. And fortunately, it's gone well for us, over the years, but so, the bar is, super high But, we really want to be with the guys who are getting the best entrepreneurs. And if they, can show us that they're, getting these phenomenal entrepreneurs, getting good, decent ownership and can add, great value longer term, that's super important for us.
Yeah. So if I'm, maybe I just invested or raised, or I'm on fund 1 or 2-ish, or maybe 3-ish, I want to get to fund 4, 5, 6-ish. How should I think about scaling my strategy if I'm a VC? Like what if maybe we can think about what you've learned or lessons from your side, but what should I be thinking about as I scale?
So first of all, the big question is, do you want to scale, and should you scale? Right? Just because you're a good investor as an early stage investor doesn't necessarily mean you're a good growth investor, right? So a lot of people have been doing growth funds on top of their early stage funds, but who's to say that, they're going to be a good growth investor?
Yeah. Have those worked? What have you seen in the data?
Some have worked, some have not. You got to, and it's, I think the ones that have worked really well actually have been the people who brought experienced growth investors to manage that portion of the capital. And it becomes almost a best of, they're trying to build best of breed teams, essentially, for the different vehicles under the same brand. But, that's one question. Another question is, there's an at least, there are two kinds of philosophies. There's some funds that kind of look at their fund as a bunch of individual investors who are doing, have an allocation of capital and doing their own investments. And, that's worked really well for certain groups. My personal view is, and it's worked extremely well for certain groups, and we're in some of those groups, right? There's other groups that take the view, and certainly this is how we work at Vintage, that, none of us has a monopoly on good ideas, and it's a good thing that we can challenge each other, and we can be honest with each other, and we can, and not be offended. And it's not like, hey, I'll prove your follow on if you improve my follow on kind of thing.
What? Okay.
And I don't think that's like a good thing to do. Right. And I think one of the key things is, can you maintain the culture of your organization if you scale? If you bring on additional partners, is that same honesty still going to be there? Is the same teamwork still going to be there? What's interesting, Turner, is as VCs, we could do a much better job in managing our own businesses. In fact, I think some of the companies, if they managed themselves the way we as VCs managed our business, they'd go under just because of that. We're not sufficiently focused on what's the culture we're trying to build within the organization. What are we, what's the relationships we want to build between the partners? What's the relationships we want to build with our customers, the entrepreneurs and the LPs? And I don't, we're too focused on the individual investments and less focused on how do we really want to build the firm. And many times we're kind of doing some of the same mistakes that some of the VCs, some of the entrepreneurs have made, which is, I need to be a unicorn. Well, I need to be, a certain size. Otherwise I can't be a player. No, you gotta, what's the right size for you to make the maximum return should be the question, not what's the right size for you to be a player.
So sometimes a smaller fund size actually leads to better returns.
Oh yeah. Yeah. We're big believers that size is the enemy of returns in venture. And if you're going to scale it, you better have the right people to scale it and not lose the culture. I've seen too many cases where people scaled and lost the culture, and you could see that was going to happen, and we didn't continue.
Yeah, I think one thing I feel like you've done a pretty good job at, or at least, I don't know if you've done a good job, but you talk about it. So maybe we'll see, because you're in the process of doing it now, thinking about succession planning. How do you succession plan? Like, what are the things to really think about and not mess up in this process?
So 10 years ago, I wrote a blog that said, at age 62, I'm going to gradually, cut down. And that's exactly what I've done. So
you're 63 now, right? Yeah. Okay.
I'm going to be 63 this year. Yeah. And so I was already working on this 10 years ago, and I said, okay, I want to build 2 generations down of team members that could take Vintage forward for the next 30 years. Right. So not only people in their, 40s, 50s, but people in their 20s and 30s that can be the next generation after that. And so one of the things that I've done is I've been looking for people who can Just like entrepreneurs who can scale, I've been looking for investors who can scale, right? Into leaders, giving them the tools to become leaders. I think we're also pretty unique at Vintage. Every single person, including our receptionist, gets carried interest. We've been doing that since day one. I want everybody to feel like they're part owners of the business. And first of all, I want everybody to make money. But on top of that, I want everybody to feel like, they're part owners of the business and to develop and to feel they can develop within the firm. And I think that's allowed us to, that's another thing. Final thing is, you got to realize, at a certain age, as much as you may like what you're doing, and I like what I'm doing, you're not going to be able to recruit really good people if you're holding on and, from the grave. Okay. You got to basically say that the right thing for the firm is that you've got to start stepping away. Another thing that we've done is we're among the GPs, we're an equal partnership. I think that's a healthy kind of relationship to have as a firm. And it also means that you're having a very high bar to be a partner. It's not just saying you're a partner, right? And that also allows you to build, for the future. So I've seen too many guys hold on economically and otherwise, and not letting go. And you gotta learn to let go.
What's the danger of not letting go? Like, what happens if you don't do that?
The firm can fall apart. I've seen too many firms that basically the good younger people have said, look, this is crazy. I want to be the boss at some point, right? I don't want to be holding on forever and be the junior. And you lose great people. And why is that important? Well, we talked about this before, right? A lot of these funds survive for like 15, 20 years. Who's going to manage it? You're going to do annual meetings in assisted living. What do you, at some point, and you owe it to your investors, right? Like at the end of the day, you have to make sure that somebody's going to be able to manage this thing. You're taking public money. That's a huge responsibility, so I think it's the right thing. It's the right thing to do for the firm. It's the right thing to do for your investor base to learn how to build, to be able to let go and build a significant, sustainable business.
Yeah. And you're 63, but you're still involved, right? Like you're still.
Yeah. I'm my partners have raised at age 62. You stop raising new funds. So I stopped raising new funds. My partners have raised a new growth fund that we haven't yet started to deploy. We're going to deploy it, sometime later in the year, that I was not involved in. I'm not on the investment committee. I'm not, they're running it. And, that was a great test because they were able to do it with, and knowing. And the other thing too, by the way, we said to our LPs, 6-7 years ago, this is the succession process, and it's also going to apply to them, right? So we have, our LPs have total visibility into our succession process. We don't hide it from anybody. We're very public about it.
Yeah. So then what are you doing next? I mean, you're still involved in Vintage, but what are some of the new projects you're starting to work on?
There's a few things I always want to do. I'd love to do a doctorate in history. That's something I, hope to do one day, but a lot of nonprofit related activity. Fortunately things have gone well, and there's a number of issues that are super important to me personally. And one of them is, trying to beat people from diverse communities into the high tech industry in Israel, where I'm based. It's particularly important. So we've done a lot around bringing people from the Palestinian Israeli community into the high tech industry, and want to continue to do that. Beside the economic empowerment, maybe I'm crazy, but I'm one of these optimistic people who believe vast majority of people are good people. And I want us to be in a situation it's for my friend from work and not my enemy. So we have, recently an amazing gentleman joined us a couple of months ago. We announced it. Summer Haji Yihya, who's a Palestinian Israeli who became the chairman of our international advisory board. We have people from the Palestinian community in our firm. And I think it's extremely important that, we continue to build that. So I'm trying to do a lot of nonprofit activity around that. So those are, that's one issue. Another, significant issue is I think we have a lot of work to do to strengthen the universities in this country and university research. So I'm going to be working a lot around that. So I've got a bunch of projects right now that I'm involved in.
Yeah, it's exciting. And I think you were mentioning usually like a lot of people, I feel like, sometimes diversity, inclusion, all that kind of stuff, we can like overlook certain aspects of it or lean too much into certain elements of it. But I think you were mentioning before, like it actually generally, if you have a diverse point of views and team member experiences, like the team actually performs better also.
Well, yeah, and I seen it with us. I mean, I think having a diverse team is you get out of the groupthink, you're right, and I think it really helps a lot. I mean, we're 7 partners, 3 women, 3 of whom are women, and I think it has a big impact on how we make decisions and the perspectives we bring to the table. And I don't look at it as like I've got to do a check mark. I actually, it doesn't mean like go recruit diverse people just because you got to say
check the box,
right? But I think what you got to do is you should go for the best person, and if the best person is diverse, great, right? But I think one of the problems that we have as an industry is we don't look hard enough to find the great diverse people, and so we've made a conscious effort every time we recruit to make sure we have diverse candidates. Doesn't mean we're going to take the diverse candidate, but we want to make sure we have diverse candidates every time we recruit, and that's the only way we're ever going to continue to build the team. And I think we're a better firm for it.
Yeah. Speaking about becoming a better firm, how did Vintage turn out differently than you thought it would back when you started? Anything that stands out?
Oh yeah, I never thought we'd get to this. I never thought we'd grow to where we are. I knew we wanted to add like a lot of different functionality and eventually get much more international and everything else. But I never thought we'd. It's gone very well for us. I never imagined it would go as well as it's gone for us. And thank God, I'm grateful for that. But I think the other nice thing about it is you never know that after 21 years, you're going to be able to say, I love my partners and I love my partners. I've been fortunate to work with phenomenal human beings, and you see it up in the ups and you see it in the downs, and we can disagree on all sorts of stuff. But man, if I could do it over again, I would do it with the same people.
Wow. Okay. That's a very big endorsement for the current team then.
By the way, I'm an LP in the current fund, in the new fund that I'm not part of. I'm serious. In the new fund that I'm not part of, I'm an LP. Not because I had to be, because I think I'm going to do really well with them, and they're great human beings. And you know what? Gets back to the culture point we talked about before. I want to be proud of the people I'm working with and proud of the people I call my partner.
Yeah. On that note, I think this is a great spot to wrap up. This was an incredible conversation. Thank you so much for coming on.
Hey, Turner, thanks a ton. It was really nice chatting with you, and I really appreciate it. And good luck, continued good luck, and continued success.
Thank you. Thank you for listening to The Peel. If you want to support the show, share this episode with a friend and check out our wonderful sponsors in the show notes. If you don't want to miss future episodes, subscribe to my newsletter in the show notes, and you'll get new ones plus the transcripts in your inbox every week. Thanks again for listening. See you next time.
Hey everyone, Eric here. At Turpentine, we're building the first media outlet for tech people by tech people. We're the network behind the show you're listening to right now. We have a slate of hit shows across a range of topics and industries, from our AI and investing cluster of podcasts to shows that drive the conversation in tech with the most interesting thinkers, founders, investors, and influencers, like Econ 102 with Noah Smith. We're launching new shows every week, and we're looking for industry-leading sponsors. If you think that might be you and your company, email me at ericaturpentine.co. That's ERIK at turpentine.co, and let's partner together.